If you're going through a divorce and you're wondering what happens to your house and whether you can actually buy a home on your own afterward, I wanted to give you the real answer. Yes, you can, and probably sooner than you think. I'm Amy Trejo, a loan officer at Treadstone Funding. I help people buy homes in the middle of divorce all the time. Most people don't realize that until your joint mortgage is officially resolved, both of you are fully responsible for that debt. Both names, both credit reports, and both finances. If your ex stays in the house and misses a payment 12 months from now, your credit takes the hit. Additionally, if the loan stays open, it counts against your next mortgage qualification, and it can make it incredibly difficult to qualify for your next home. That's why doing this right and doing it in the right order matters so much. I'm gonna break this down in this video in two parts. First, what actually happens to the home during a divorce. Then, how you position yourself to buy the next one. You have three primary options for the marital home. There is no universally correct answer. There is only one that fits your life, your finances, and your goals. Let's walk through them. Option one, sell the home and split the money. The cleanest path is to sell the home and use the money to pay off the mortgage. Cover the closing costs and split whatever's left between you, according to your settlement. This is usually the right choice when neither of you can comfortably carry the house payment on a single income, or when both of you want a completely fresh start. It ends the financial entanglement in one clean transaction. Selling ensures you have no ongoing joint debt, no shared liability, and certainly no lingering credit risk. This is usually the right choice when neither of you can comfortably carry the house payment on a single income, or when both of you want a fresh start. It ends the financial entanglement in one clean transaction. Selling ensures you have no ongoing joint debt, no shared liability, and certainly no lingering credit risk. The trade-off is that it can be emotional. For a lot of people, it's necessary and healthy. For others, especially when kids are involved, it's harder. Option two, refinance and keep. The second option is where one spouse keeps the home by buying out the other's stake or equity in the home, usually through a refinance. The math here is straightforward. Take the current value of your home, subtract what you still owe on the existing mortgage, and what's left is your total equity. A 50-50 split means one spouse owes the other half of that number. To make that happen, the spouse keeping the home refinances a loan into their name alone and typically pulls out the cash from the home's equity to pay the buyout. They are required to qualify for the new mortgage on their single income, single credit profile, single everything. There's a specific loan program called a limited cash out refinance for divorce buyouts, which can offer better loan to value terms and rates than a standard cash out refinance if you've both been on the title for at least 12 months. Definitely worth asking your loan officer about. This option is usually the right fit when the spouse is emotionally attached to the home or when keeping the kids in the same school district and neighborhood matters more than the financial simplicity of selling. The third option is to keep the existing mortgage in both names, with one spouse living in the home. To be honest, this option carries real financial risk and is likely best as a short-term solution. It's risky because both of you remain fully responsible for that debt. If the person living in the home misses a payment, both of your credit scores take a hit. As long as that loan is open in both names, it can make it very hard for the departing spouse to qualify for a new mortgage of their own. This is because the existing mortgage decreases your buying power as long as you are liable for paying, even if you're not. Sometimes this is the right short-term move. Maybe the market isn't right to sell or a refinance doesn't pencil out yet. If you go this route, do it with eyes open, with a clear written timeline and with a plan to transition selling or refinancing down the road. How the mortgage actually gets resolved. A refinance replaces the current loan with a brand new loan in one spouse's name only. That spouse has to qualify on their own. The second path is called a release of liability, sometimes combined with a mortgage assumption. This transfers the existing loan to one spouse without replacing it, which means the interest rate, terms, and payment stays the same. That's valuable if your current rate is better than what's available today. Mortgage servicers, who can be different than lenders, don't always offer this. but it's worth asking. A release of liability often succeeds where a full refinance request wouldn't, but this release does not automatically exempt you from paying out your ex-spouse. So there is usually additional math and planning required in this case. Here's an example of the refinance option. Sarah and her ex-husband owned a home worth $400,000 with $200,000 left on their mortgage. After the divorce, Sarah wanted to keep the house for stability and familiarity for their 2 kids. She needed to buy out her ex's stake, meaning she needs to pay her ex $100,000, which is half of the remaining $200,000 of equity. She decided on a limited cash out refinance, and with Treadstone, she refinanced to borrow $300,000. This amount replaced their current joint mortgage and gave her the $100,000 needed to compensate the ex-husband. While her monthly payments increased slightly due to the larger loan, Sarah could remain in her home and manage the payments within her budget. This process allowed both parties to split cleanly without much trouble. Now, if you're the spouse moving out, or if you're selling the home together, you're going to need to buy another house. The only proper way to see what you can qualify for is to talk to a licensed loan officer. There's a link in the description to get in touch. Either way, here's how to put yourself in the strongest possible position. Start with the 4 things lenders actually look at. Your next mortgage approval comes down to 4 things: your credit score, your debt to income ratio, your stable income, and your assets. Your job between now and your next application, which could be today, is to strengthen all 4. Pull your credit report and dispute anything that shouldn't be there. Divorce is notorious for leaving behind joint accounts, missed payments on shared debts, and credit cards that were supposed to be your ex's responsibility, but still show up in your life. Pay down your existing debt where you can, especially credit cards and auto loans. Lower debts in these categories directly increase how much house you can qualify for. And document everything: divorce decree, court orders, proof of support payments, tax returns, bank statements. Lenders want a clear paper trail. If you receive alimony or child support, yes, lenders can count on that as qualifying income. A few rules: it needs to be in a court order. You need a documented history of receiving it consistently, and it has to be expected to continue for at least 3 more years from when you apply for the mortgage. If you're the one paying support, those payments count against your debt to income ratio. It doesn't disqualify you, it just means your buying power is smaller, and you want to plan around that from day one. Either way, I recommend being upfront with your loan officer about the full picture. It's the single best thing you can do to get a clean and accurate approval. Here's what I want you to take away from this. A divorce doesn't close the door on homeownership. Not even close. It just changes the order of operations. Deal with the existing home. Protect your credit during the transaction. Strengthen your full financial picture. And when you're ready, buy again on your own terms, in your own name, in a home that reflects the life you're building. If you want to understand what's financially possible for you specifically, or have questions about your next move, reach out to a Treadstone loan officer. The conversation is free, there's no pressure, and we'll walk you through the real numbers so you can build a confident plan. Again, if you have any questions, please reach out. It's our goal to make this chapter of your life as easy as possible.